It's the night of January 18th, 2026. The closing bell has rung, the headlines have gone quiet, but if you're watching the metals market closely, you can feel it. The pressure, the tension, that unmistakable calm before something snaps. I'm an independent commodities analyst. I've been trading these markets and accumulating physical silver for over a decade. I started this channel for one simple reason: speed. I got tired of waiting hours or days for legacy financial media to explain moves I was already watching unfold live on my terminal. And honestly, I got tired of seeing recycled hype, AI-generated clickbait, and surface-level commentary drowning out what the data was actually saying. That's why I use this format. No theatrics, no filler, no hype loops, just real-time analysis, real numbers, and uncomfortable truths delivered faster than the mainstream ever could. Tonight, I need to walk you through something that's happening right now, something most financial outlets won't touch because it exposes a mechanism they'd rather you never understand. Here's the setup. Silver was slammed earlier today. At precisely 9:45 a.m. Eastern, price collapsed, down roughly 4% in a violent move, the kind of drop engineered to hit stop losses, trigger margin calls, flush out weak hands, and scare retail traders out of the market for good. And what's the story you're being sold? They're calling it a healthy pullback, a cooling off phase, a tired bull market. They want you to believe retail lost confidence, that the silver trade is over, and that capital should rotate back into whatever asset class is being promoted this week. But that story doesn't hold up because the screen is lying. While silver futures were down nearly 4%, the companies that actually mine silver barely reacted. The silver mining ETF opened down only about 1.4% and recovered most of that loss before midday. Read that again. Silver down 4%. Miners down 1.4%. That's not weakness, that's relative strength. And relative strength at moments like this is a warning signal. It's the market quietly telling you that the official narrative is wrong. Here's why this matters. As you're watching this, we're less than 12 hours away from the third Friday of the month, monthly options expiration. For anyone who's spent enough time in these markets, you already know what that means. It's one of the most dangerous days of the quarter for institutional short sellers. Billions of dollars in derivatives are about to either pay out or detonate. And there's a reason the miners haven't been allowed to move yet. It's not because they're weak, it's because they're being held down by something very specific, very deliberate, and very expensive. Here's my thesis. Silver mining equities are being artificially suppressed to protect massive short positions held by large financial institutions ahead of options expiration. That's what I'm going to demonstrate, using basic math, observable market behavior, and a mechanism most retail investors don't even know exists. Let's talk about the contradiction. Silver is trading near $91 an ounce. Mining equities are priced as if silver were still $30. That's not a lag. That's not slow price discovery. That's a structural mispricing that should not exist under any rational valuation model. And here's my commitment to you. I'm going to break down why this sector is effectively spring-loaded. I'm going to explain operating leverage in plain language. And I'm going to share exactly how I'm positioning for the next 24 hours of volatility. Because in 2025, silver surged more than 140%, making it one of the best performing assets on the planet. And the miners? They're only just beginning to stir. This isn't theory, this is math. And the catch-up move isn't optional, it's inevitable. Earlier today, around 11:45 a.m. Eastern, I was watching my screens. Gold was hovering near $46,159 down marginally. Silver sat around $91.50, slightly red. Nothing dramatic if you ignored the intraday tape, but that tape told a very different story. At 9:45 a.m., silver was deliberately flushed, a sharp, sudden drop designed to look like capitulation, designed to trigger cascading sell orders, designed to create panic. That's not randomness, that's a stop-loss sweep. You push price fast and hard through key levels, retail stops get hit, forced selling accelerates, algorithms pile in, and suddenly you've manufactured a self-feeding sell-off. That's how weak hands are shaken out. But here's where the story breaks. While silver was being crushed, the miners barely budged. They opened slightly lower, and within an hour, they were already recovering. By late morning, they were showing clear relative strength. And if you've traded equities long enough, you know what that means. It means someone is defending a floor. It means capital is stepping in quietly. It means the smart money is buying while fear is peaking. When I pulled up the intraday chart, the recovery was a near perfect V-shape. Retail doesn't do that. Institutions do. So the obvious question becomes, why is there such a desperate effort to keep silver below $92? The answer lies in one concept: operating leverage. And if you understand this, everything else clicks into place. Operating leverage is what happens when revenue explodes but costs don't. Think of it like this. Imagine you sell lemonade. It costs you $1 to make a cup. You sell it for $1.10. You make 10 cents. Now demand spikes. The price jumps to $10. Your costs don't change much. Lemons didn't get 10 times more expensive. Now your profit isn't 10 cents, it's $9. That's operating leverage. And that's exactly what's happening with silver miners. Most silver producers have all-in sustaining costs, AISK, around $30 per ounce. That includes labor, fuel, equipment, taxes, everything. At $35 silver, margins were razor thin. Survival mode. At $90 silver, margins explode. Here's the math. Profit margin equals price minus cost divided by price. At $35 silver with $30 costs, $35, 14%. At $90 silver with $30 costs, $60, $90, 67%. Profitability didn't double. It didn't triple. It multiplied. And yet the equities are still priced like nothing has changed. That's the trap. That's the distortion. That's why this is one of the most undervalued sectors in the entire macro landscape. Now let's address the skeptics because some objections are valid. First, rising costs. Yes, costs have increased. Diesel, labor, equipment, all higher than 3 years ago, but they haven't tripled. Even if AISC rose from $30 to $40, that's a 33% increase. Silver went from $35 to $90, a 157% increase. The margin expansion is visible in earnings reports. Free cash flow is surging. Debt is being paid down. Dividends are rising. This isn't speculation. It's in the filings. Second objection, jurisdictional risk. Governments might tax profits, change rules, add royalties. That fear is exactly why these equities are cheap. But markets move faster than governments. The re-rating happens before legislation does. We're not buying these stocks for a 20-year hold. We're positioning for the violent repricing that occurs first. Third objection, short interest. Short volume in several major silver miners is at extreme levels. That's not prudent hedging. That's desperation. And short positions create their own fuel. When price rises, shorts are forced to buy. That buying drives price higher. That triggers more covering. That's how squeezes begin. Now let's talk about tomorrow. Monthly options expiration. There is massive open interest clustered around $90 and $95, billions in exposure. If silver holds above those levels into the close, institutional losses mount quickly. Expect volatility, expect nonsense moves, expect headlines designed to distract. If control is lost at $90, things get ugly, fast. And notice how quiet the media is. No discussion of record margins, no discussion of free cash flow, no discussion of valuation disconnects. That silence is not accidental. This is the accumulation phase. So here's what I'm watching. 1. The ratio between silver and the miners. If miners start outperforming, decoupling has begun. 2. The dollar index. Dollar weakness amplifies metal moves. 3. Price behavior at $90. If buyers consistently defend it, suppression is failing. Now, my personal approach, this is not advice. If miners finish flat or green while silver stays red, I add, that's confirmation of decoupling. If silver holds above roughly 90 WAR 50 through peak OPEX volatility, I see the floor as real. If silver collapses below $85, I step back. No hero trades. OPEX days exist to cause maximum pain. Discipline matters. My broader target is a retest of prior cycle highs in the mining ETFs. Based on historical margins, fair value is multiples above current prices. But I won't hold forever. When euphoria returns, when everyone suddenly believes, profits get taken. Right now, we're still in disbelief. That's where opportunity lives. Let me close with this. Silver is priced for today. Miners are priced for yesterday. Options expiration is forcing that contradiction into the open. The math is undeniable. The setup is real. Now we find out whether the paper market can keep ignoring physical reality. I'll be watching closely. If something breaks, I'll be back. Until then, stay disciplined, stay focused, and don't let the noise blind you to the signal. The numbers don't lie. The prices will catch up.